This is a stock analysis update for Yellowcake. Remember that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. Ticker symbol YCA.L. They're listed as a equity on the London Stock Exchange, but actually Yellowcake are a lot like a uranium ETF. They allow you to speculate on the uranium spot price. And they do this because the vast majority of this company's assets is yellow cake. So that's the form of uranium after it's been mined, used to go into nuclear power reactors. They currently own about 19 million pounds worth of yellow cake, worth about 1.2 billion. And they store these in Cameco and Orano's secure facilities in Canada and France. Yellowcake have a deal with Kazatomprom, who are the world's largest uranium miner, whereas they can buy £1 million worth of uranium off them every year. Now, this would actually dissuade me from investing in Yellowcake if I hadn't already done so back in 2020. And that's because the only way that this uranium can get to the rest of the world out of Kazakhstan is through Russia. We see here the route it takes from St. Petersburg to the rest of the world. And these shipments are still going on, but obviously there's a lot of concern that these exports are going to get banned. And now there is talk of Kazakhstan using this alternative route, which is via Azerbaijan, who are of course at war at the moment, and then through Turkey. But the reality is that although this route is being used a little bit, in order for them to scale it up, is going to take them so many years that, as far as I'm concerned, the uranium is landlocked within Kazakhstan if Putin so decides. Other countries that surround Kazakhstan are countries like Iran and China, and it wouldn't be practical to get this uranium out of Kazakhstan any other way at any volume. So be aware of this if you're thinking of investing into Yellowcake. Yellowcake share price is currently about 6% discount to NAV, and it generally is a good track of the uranium spot price. In this graph here, the blue bars is their uranium they own, and the red bars is the cash that they have. And you can see that in 2019, when they IPO'd, they raised 200 million and used it to buy some Yellowcake. Then over the years, they've done several capital raises, and each time they increase the amount of uranium they have. Now, what they have done is when they were at a discount to NAV, then they do share buybacks. The most recent actually being this year when they did 0.6 million of share backs at a 10% discount to NAV. And then when they do that, they essentially buy more uranium at a decent discount by doing that. And those shares are then held in treasury, they're not deleted. And then also they can use those shares in treasury to sell shares to then use that money to buy more uranium, stocks trading at a premium to NAV. So this is how they behave like an ETF and how the share price should track the uranium spot price fairly well. So in terms of the uranium spot price, and it was very subdued for a very long time. And then we had this uranium bubble of 2007. And then after being completely down and out, we have seen a bit of a bull market in the last few years. If you go back to 2020, you can see when I did my first video on Yellowcake, I bought some Yellowcake around the time of that video. And then I did another video only last year where I looked at $70 as a good target for this year, where I kind of agreed with the Bank of America's prediction that that's what the price would be this year. There's obviously a lot of excitement at the moment, and people saying that maybe we're going to have a repeat of this bubble of 2007. Obviously, for me, I'm in a very good position, and even at the current price, we're talking about roughly a 3x for me. So I really am now using this video to seriously consider my end game for yellowcake. So to go and look at the spot price and what's been going on around that, this green line accounts for inflation, whereas the blue line is the nominal price. And we see that back in the 70s, there was a big bubble in the uranium price. Interestingly, this was preceded by an oil crisis, and we are in some kind of an oil crisis or energy crisis today. And in the 70s, there was a lot of reactors being built around the world. Then, however, nuclear power became very unfashionable. We had the 3 Mile Island accident, and then the Chernobyl disaster, and we went through 2 decades of a very subdued market. And throughout this time, there was serious oversupply of yellow cake. However, there was then this spike in 2007, and this was because after these 2 decades of oversupply, we actually started to get into a bit of a undersupply situation. Plus, there were some hedge funds going in and mopping up uranium off the spot market. But it's mostly been attributed to these floods that there were at the MacArthur River mines, and also Cigar Lake mine in Canada came together in a perfect storm. But there was clearly a lot of mania and speculation in that spike. And then, of course, the that bubble burst, and then Fukushima helped things along, and we've been in a good decade of a very suppressed market. And the situation when I bought my yellow cake in 2020, you can go and watch that video yourself. The situation then was that everyone still hated nuclear power, and the utilities had got all very complacent. They could always get hold of new yellow cake, and it was a very suppressed market. This slide is actually from that video that I did, and you could see that back then, at around $30, at $30 a pound uranium, the vast majority of the mines in the world couldn't actually even mine uranium at a profit because the price was so subdued. And this for me was a great reason, as I explained in that video, to then invest in yellowcake, if nothing else. Plus the fact that yellowcake was trading at a 20% discount to NAV back then as well. Of course, now that the price of uranium's gone up to $65 a pound, now, of course, that reason for buying is out the window. Now all of the mines can start producing uranium at a profit. So we're now in a undersupply situation, which has led to this bull market from 2018 to now. Also, we've had this. Also, nuclear power is in fashion all of a sudden. There's all this net zero mania everywhere, and all the governments are scrambling to fly the nuclear power banner all of a sudden. Plus, the Sprott Uranium Trust have started buying up uranium, which is like a new pressure that wasn't there before. And of course, the war in Russia has put pressure on supplies, because actually half of the world's uranium is mined in either Uzbekistan or Kazakhstan, and that can only get to the rest of the world via Russia. Like I said, there are other routes, but they're going to take many years to set up at volume. And so this concern has, I think, also helps along that bull market. So there's a lot of excitement, and you can go and look at some YouTube channels and other sources where there's a lot of people getting very excited about uranium. But really, for me, when I look at the 40,000 foot view here, it's not really so exciting for me at the moment. It's more like a orderly repricing. And the thing is, the time scale, it's a very long time scale, and it's a very kind of slow market, I think, in terms of how the market develops. And when I look at this chart here, for me, it's like an orderly repricing. It's a nice bull market, but it's not anything too crazy yet. It's kind of fairly orderly to me when you look at it in the right time scale. Of course, everyone's looking at it in this time scale, but that can look like really exciting. You can see everyone going crazy on all the YouTube channels, but actually, that's only gone. It's only gone up from 50 to $65 a pound. So really, it's not yet as exciting as I think people are making out, especially when you look at it in this context. For me, I've got this channel here, which is the controlled repricing. And the most obvious reasons for that are the Kazakhstani supply concerns and also the drying up of the spot market, which I'll go into a bit later. But still, for me, I should be keeping a cool head here because we're not really mooning yet. Also, because I bought down here, and I actually bought at $30 a pound, but because I got a 20% discount to NAV, I actually got it for more like $25 a pound, and we're now at $65 a pound. I'm in the worst case, I can give it a wide stop loss, and the worst case is I've still done really well. We're currently near a 3x, and I could actually give myself a lot of wiggle room and still be walking away having doubled my money. So I really have got some grounds to chill here a bit. But what's for sure is I consider my uranium investment to be in the end game stage at the moment. And now I need to try and work out, okay, what's the best strategy here? I'm going to go into the supply and demand dynamics of the uranium spot market. But before I do that, I'll take a quick look at the yellowcake equity first, because I think it's important to understand that. And in terms of the profit and loss account, we see that the vast majority of their income or loss any year is quite purely the appreciation or depreciation of their uranium assets that they store. And because of that, their operating profit and net income is fairly irrelevant actually in terms of analyzing this stock. When we look at their expenditure, we see that their expenditure is currently 0.6% of their assets, of their net assets. So that's fairly good. So if you're looking at investing in this as a ETF, that means they've only got a 0.6% management fee, if you like. So that's something I was keeping track on ever since the first video, and it's all looking good. Then we look at their assets. We see that, of course, the vast majority of their assets is just the uranium that they hold. And I believe that's going to be worth over 1.2 billion as of now. We see that apart from the uranium, the only other assets they have is essentially cash. In terms of their shareholders, these are all their major shareholders, and actually apart from Kopernik buying some, there's generally been not much activity that I've been able to detect there amongst all the major investors. It's very interesting that actually roughly half of this company's investors are retail investors, which is a very large amount actually, be warned. So looking at the supply and demand dynamics of the uranium spot market, and first of all, we need to start with reactor demand, because obviously a lot of people must be thinking, hey, they're building loads of nuclear reactors everywhere, therefore price go up. So here I've got the World Nuclear Performance Report for 2023, which is published by the World Nuclear Association. We'll see that actually electrical production from nuclear energy is fairly stable over the last decade. And of course, in Asia, they're building more reactors. We've been devolving in Europe, particularly countries like Germany. But overall, in terms of gigawatts, the capacity's been fairly stable. We see here that roughly a third of all nuclear power is in Asia, with a quarter in Europe and a quarter in America. And there's actually about 60 reactors under construction, which would represent a 14% increase on this. Interestingly, China and India represent half of all new builds. But we see here that it actually takes between 7 and 17 years to build a new reactor. So typically the Chinese are doing them in only 7 years, but in the West it takes us forever. So although there are a lot of reactors being built, it's going to take a long time for them all to come online. And here there's a nice table where we see in the first half of 2023 there was 3.6 gigawatts of new grid connections and about 3.5 gigawatts of new reactors started construction, mostly of course in China. However, there were 6 gigawatts of shutdowns. However, I think that's a bit of a anomalous period because we had the shutdown of these three reactors in Germany, which was the insanity that's going on there. If you were to take that as a German anomaly, there is obviously reactor growth here, but because of the time it takes to build the reactors, it's going to be over decades, not in the next year or two that we'll see the significant increases in demand. What's good about this report is they go through every country and you get to see how many reactors they have and how many they're building, and get a nice graphic here where you see the profile of how many new reactors and how many old reactors they have. It's a bit depressing really because you see how progressive the communist countries are, like China, where it's all brand new reactors and they're really ambitious. And then you compare that with the UK, where you can see how we've let our nuclear industry just run into the ground, and that we've now got all these old decrepit reactors. But the main takeaway from looking at reactor demand is it is going to go up over time, but we're talking decades. So don't look at all these reactors being built at the moment as a reason for the spot price of uranium to go up. The increase in reactor demand is going to be rather slow and it's actually going to be a very long-term ramp up. Now, another thing is the the actual utilities. They have their own inventories. Now, I couldn't get very good numbers for that, but they seem to be, maybe roughly half, say, of what you see here for the civil stockpiles numbers. But the fact is in recent decades they've actually been drawing down those inventories rather than actually buying off the miners. Bear in mind that there is some slack there, so they don't have to buy uranium every year, or they can't fuel their reactor. They have inventories already, which is an important buffer to kind of consider when you look at this model. But then in terms of mining supply, and the World Nuclear Association website has this really helpful table where you can see how actually mining supply has been going down over the last decade, and indeed it's only 74% of world demand. So currently the mining supply is not enough to meet reactor demand, and it's only 75% of reactor demand. And this is because the utilities for a long time have been using their own inventories, but then also using perhaps 25% from the spot market and from secondary supply. And so this bull market is fairly neatly explained actually by generally the change from the past, where the utilities were just using inventories and secondary supply, to now a point where those supplies are perhaps starting to dry up a bit, and they're having to turn to the miners to sign long-term contracts more, and so then that sends the price up. So I've got this nice graph here from the World Nuclear Association. I've also used some NEA and IAEA data, which you see in these bars here. According to this, you see how this line here is the actual mean case of reactor demand. With this line up here, the worst case, and then the line down here, the best case. So you can see though that in recent years, exactly like you see in this table here, the mining supply, which is these bars at the bottom, hasn't been enough to meet demand, and so they've been soaking up uranium from the secondary market instead. But what we see is that actually in the next year, we're still in this point where there's a shortfall. But then actually from 2025 through to about 2029, the mining supply is expected to go up and will meet reactor demand. But then when we get to say 10 years from now and onwards, then we should start seeing a serious shortfall in mining supply. So based on this data, yes, there is like a mining shortfall now, but there won't be in a few years' time, and then it won't actually be until the mid 30s before we get to the next serious shortfall. So be wary of that, because this trend coming in the next few years is something that could obviously bring the price of uranium down. Okay, so to just think about the fact that you have the long-term contract market, which has only been covering actually three-quarters of their need, and then the spot market. I've got here the numbers for that, and you can see that the long-term contracts, which is where utilities sign contracts for many years in the future, not just the current year, but the volume for that had been relatively low in recent years, as I've explained, because they were just using their inventory or using spot market supplies. But then the last couple of years, it really is ramped up, and it's to record levels so far this year. And you can see that actually the amount of spot activity has been dropping a lot. Now, also the spot activity in 2021, 2022, the Sprott Uranium Trust came in and actually hoovered up a quarter of the entire spot market. And that actually coincided with this shoot up here and this shoot up here in price. This bit here was actually the Russia invasion of Ukraine that caused that. But that does make these kind of anomalies caused either by the Russia invasion of Ukraine or by the Sprott trust purchasers. Because obviously, as you can see, they buy a quarter of the entire market over a period of a few months, and that's obviously going to spike the price, but in a temporary fashion. And that's, I think, what happened there. But otherwise, it's a very thin, well, it's becoming a very thin market. It's now actually only a quarter of the long-term market. So this does really lean towards evidence that we're seeing a shift from the situation where the utilities weren't seriously buying off the miners, and instead were just using spot to complement what they need, to a situation where now they're relying on the miners to secure their supply. But then, of course, you see this big supply and demand dynamic here, because the miners can only actually provide three quarters of reactor demand. So that does explain this controlled increase of the price over a long period of time. When I look at this yellow cake slide, this shows, as you go into the years into the future, how covered the US and the EU utilities are. And remember that these are half of all nuclear fuel requirements, is the US and EU. These are a lot to do with the spot price. And you can see that actually, although there's a dearth in the EU at the moment, but obviously the Germany have shut down their reactors there. 3 years from now, there's going to be a bit of a shortfall in Europe, plus a shortfall in the US. So there's obviously a lot of pressure, because 3 years from now isn't long in terms of building a nuclear power supply chain. So it does actually make sense that the utilities are coming in now to cover this shortfall 3 years from now. So from going through those aspects of the reactor demand, which we don't expect actually to be going up that fast, and when it goes up, it will be over many, many years, because it takes so long to build a reactor. But from looking at that, but then looking at the term contract market and then the spot market, how that feeds into this, we do see definitely that the spot market, which the utilities had been relying on, does seem to be drying up, and we get a nice explanation for why we've seen this trend then in the last few years, which I call a controlled repricing of uranium over a long period of time. And then, of course, the supply concerns from Kazakhstan also contributing to that. So now I'll go into the spot market, though, and the secondary supply market. So obviously, one thing is the ETF demand. I've explained how that led to these temporary pumps in the price because they were actually equal to a quarter of the total spot market in those years. But actually, this year there hasn't been much buying from the ETFs, but it's something that if it comes in, it gives a nice little boost. I've got here a table actually of the three main ones, which is Yellow Cake, which is the stock we're discussing, Sprott, and then Anu Energy, which is actually Kazatomprom's one. They've kind of set up a company that does the same thing. They were actually promising £10 million this year, but we've not seen that yet. But yeah, you can see how though the activity has dropped significantly this year compared with 21 and 22. But the important thing is these guys don't sell back into the spot market. They're closed-end funds. So you don't really have to worry about them flooding the spot market. But we can't rely on them. People are talking about it, I've seen, but don't rely on them. Don't rely on them. Yeah, don't rely on them pumping the market by buying loads of uranium this year or next. It's just they're there, and if they do, it's a bonus. Then the secondary supply. Now, in entirety, I understand the secondary supply to only be around £22 million a year, based on the World Nuclear Association website, and they don't expect this to increase in the next 10 years. So this does agree nicely with our explanation earlier why the spot market's dried up. It's all on the mining supply now, which is a shortfall, and this supply and demand dynamic explains why the uranium price has been going up. The secondary supply is mainly the civil stockpiles, which are each country has these strategic stockpiles. Now, this data is very wonky. I couldn't quite work out from reading different sources how much of these civil stockpiles are actually how much of that has the utilities inventories included within it. But let's say worst case, they're not included in it. You can see there's quite a lot here. So although we've been told this supply isn't going to increase, theoretically, any one of these countries could dump on the spot market whenever they wanted with their civil stockpiles. Also, there's these huge depleted uranium stockpiles, and this is all the uranium that's been used for enrichment to make nuclear fuel rods. But then there's just these huge stockpiles of depleted uranium. Now that if the price of uranium, if the uranium spot price went high enough, and I don't know if that's $200, I don't know if that's $400, but if it did, it would become economically feasible to start recycling some of this depleted uranium instead of using mined material. So, although this isn't really relevant for the next few years, there are sinks here which can come in and put an upper limit on the price in the long term. It's just worth something knowing about. Then, of course, there's military grade, highly enriched uranium stockpiles, and these can actually these are much more cost effective. So there are again ways that apparently the stockpiles are equivalent to 7 times the world's mining supply at the moment. Now, the governments obviously probably want to hold on to these in case they want to be making nuclear weapons, but still, there are ways here that you can have the secondary supply market impacted. Then there's also underfeeding. I go into that in my last video I did, so look at my last video if you're interested into that. And I also went into the entire nuclear fuel cycle in that video, but I won't go into that in this video. But there is these stockpiles of uranium left over from this, which also could have an impact on the market. It's important to note, though, that there is this very complicated nuclear fuel cycle, which I go into in my last video. But this, again, this then weaves in all kinds of other complexities. So you can't just go on the actual yellow cake market. There's this layer above that of enriched uranium market as well, which can impact this market. So there is then like a level of uncertainty there that you've got to then be aware of, rather than just relying on this analysis. But the main point is that although the secondary supply currently is a fairly small contributor, there are all these different parts of it which could take away supply or add significant supply within any year. But this kind of creates a lot of sag. So it means that the whole market kind of behaves in slow motion over many years. There are all these other sources of uranium that kind of interplay. But really, having gone through it all, for me, it's actually could be fairly simple. I mean, I think you could go crazy, and you can go. You can see lots of experts go into every detail of all the different parts of the nuclear industry. But me, it kind of just seems like, although there is lots of uncertainty and lots of undercurrents here, over the long term, it's fairly simple. And that's that the uranium that's required is not met by the amount of uranium being mined. That's because the utilities have been relying on the spot market, but that market seems to be drying up and we see more long-term contracting. There's huge undercurrents here, and it's a very, very slow kind of market. But in the long term, we see this orderly repricing for these fairly simple reasons. So I'm now at the end game for my uranium investment. It's done very well for me. We're approaching a 3x, and actually uranium has now become about 20% of my total portfolio is how well it's done. One thing I say for sure is that I'm looking at this long term, the lower channel of this long term trend, as my definite default exit point. This makes for a very good trading stop loss for me. I would still, if that was to happen tomorrow, which is very unlikely, I would have doubled my money and I'd be happy with that. But this is definitely my trading stop loss for my entire position. My gut feeling actually is that we're going to just stay within this channel. Though it might seem exciting at moments, I think it's important to concentrate on the spot price graph here rather than this noisier yellow cake graph. But I think that on the spot graph, we will stay within this channel. But I might be wrong, and we could go shooting up. If we do, actually the Fukushima high was about 75, so we could see resistance there, obviously, and if it went above that, it really could be a moonshot. So I'm in the end game now. Like I say, my default definitely sell is this trailing stop loss. I'm probably going to sell half of my position before then by playing if we if this continues, but I can't really detail that obviously in advance because I have to see how this develops the next few weeks. But I can say that from doing this update video and looking into the dynamics, I feel like there's a good explanation for a controlled repricing in the long term here. I'm definitely hanging on using the bottom of this channel as my trailing stop loss. And if we do moon from here, I'll definitely be looking to certainly sell half my position. And it's going to be very interesting to see how that develops in the coming year. So that completes my video for Yellow Cake. Remember that I do these videos just for fun as a hobby, and always speak to a qualified financial advisor before making any investment decision. And actually, next Wednesday at 7:30 p.m., I'll be discussing uranium with the Portfolio Matters guys. So if you're interested in that, look at their channel and look at their YouTube channel, and you'll see the link to their Discord channel there. So if you like, you can discuss any of your thoughts on uranium with me and the guys at Portfolio Matters at this Discord call, which will be Wednesday at 7:30 p.m. Please read the disclaimer. Remember that prices can go down as well as up.